my fellow freedom builders, and welcome back to the channel. If you have followed my channel for a while, you know that I do like automated strategies, I do like trend following, and today I am going to show you a strategy that you can use yourself. It is extremely simple. I'm going to show you how to set it up in TradingView. I have mentioned this strategy before, but today I'm going to go a bit more in depth with it. First of all, let's see the stats so you can see if this has any interest for you. This is a test over 23 years. It is back from 2000 and up until this very date. If we look at the CAGR, the compound annual growth rate, you would have made almost 12% per year all of these years. This should be compared to the S&P 500 in the same time span has only made 6.5%. So this strategy alone will give you almost double the performance of the S&P 500 23 years in a row. Of course not every year, but overall as an average. If you watched my video yesterday with Sharpe and Sortino ratio, you can see here that the Sharpe ratio is 0.64 compared to the S&P 0.34. This is how much performance you get compared to the risk you take on volatility. The Sortino ratio, as you know, that I like better, is 0.93 compared to the S&P 500's 0.47. So this is a lot better, and it is the simplest strategy you might ever learn. And it comes just in 1 minute. I'll teach you the entire strategy. It's very easy, and I'll show you where to find the candidates. Just have a quick look here. The max drawdown is 37%. That was back here in the financial crisis. The benchmark, the S&P 500, was down 55%, and we can see that the volatility is lower as well. An interesting fact is that we have overall almost 53% winners. And knowing that, it is also interesting to see that our average winner is almost 30%, whereas the average loser is only a bit more than 13%. So having more than 50% winners and having winners that are almost 3 times the losers, that is definitely a strategy worth learning. All right, so let's have a quick look at the strategy so that you can close the video after that if you're not interested in any more of the details with the research and everything. First of all, let us have a daily chart here. I've chosen Nvidia. That is a stock that everybody knows right now. And as you can see, that gave a buy signal in April this year. Now, why did it do that? I'm going to teach you the entry rule here in TradingView, and you can set it up yourself. You choose the indicator part here, and then you choose an indicator called Donchian Channel. So if you choose it here, you just write Donchian Channel. It comes here. I already put it on, but you just choose this one. The Donchian Channel simply shows you the highest level the price has been in X number of days. This one, this strategy is going to buy the stocks that reach the 52-week high, meaning the highest price that the stock has been the last 52 weeks. Now what I put in here, I put 250 days. That's roughly a year. You can calculate the exact number of days, but I just put 250 days in. That is just about a year. The point where the price hits the upper Donchian channel here shows us that it has reached the highest price it has been in 52 weeks or 250 days in this case. So that is a buy signal. And this is pure trend following. This is simply buying things that are in a good trend. Of course, it would have been nice to have bought it down here, but it only gave us a buy at a 52-week high here. Now that is the entry. That's all there is to it. There are no extra moving parts. Buy when the stock hits the highest point in 52 weeks high. All right, then when should we exit? Let's just remove the Donchian channel. Here you're going for something called an ATR Stop Loss. There are plenty of them in here. You just pick the ATR Stop Loss, and there are a lot of them down here. I just picked one. ATR is simply a measurement of how much a stock moves, and what you put in here is you are going to see the average movement of the stock the last 40 days. So it's looking 40 days back, seeing how much does it move from day to day, and then you time it by 10, meaning that the stop loss will be quite far behind here. So what you basically do is that you put a stop loss here. So if the price breaks down through this line immediately, you just sell. Now, every time this ATR line goes up, you let this line follow. So every time the ATR line reach a new high here, you'd let this one follow. So right now, the stop loss would be on Nvidia up here around the 300. I know it is a far way down here. It is a 28-29% loss you would have to take on the current position before it hits the stop loss, but you would be in a profit of around 10% here. And if the price keeps going up, well, then the stop loss just follows up. When you hit the stop loss at some point, you just sell the stock and you buy a new one that has hit a 52-week high. That's all there is to it. That's as simple as it is. And if we go through quickly the research behind it, it is done by something called Black Star funds. They don't exist anymore, and you could wonder if that is why it is very good. So they stopped having a fund and just invested their own money, or it could be because it was so bad that they stopped doing it. Now, their strategy is a bit different from the one we are choosing here, because they're not looking at a 52-week high, they're looking at an all-time high, meaning they have some examples down here of stocks they have bought. For instance, the EMC Corp, every time, let me zoom in here, every time this one shows a green dot, it is at an all-time high. So they only buy the stocks when they are at an all-time high, meaning the highest price it has ever been. Now we are choosing the highest price in 52 weeks. In our back test, it shows that it doesn't make much of a difference. Now, as you can see here with their examples, they have some stocks they entered, and they are having this trailing stop loss far behind. And these very long trending stocks, you just get the entire movement here. Of course, at some point the trend breaks and you get out at a very much lower point, but that is just how it is. That is how this strategy is constructed. If we take a look at the overall equity chart of the strategy here, we can see that they have a test here going from 91 to 2005. They actually did a test early on back from 1984 showing about the same results, but in this chart it is from 91 to 2005, so that is 14 years. And well, that shows that $1,000 in 14 years just tracking the S&P 500 would have given you around $5,000 left. And this strategy, just buying in this case, the all-time high stocks, would have yielded you a lot more, of around the $12,000, or 2.5 times what the S&P 500 did. If we're looking at the year-to-year returns here, we can see they are also month per month, but we can see here that the Black Star model is here, the S&P 500 is here, and you can see this for yourself. Now the CAGR, annual compounded return here, is 19.3%. That is a bit higher than what we have found, but again, in this time span here, the S&P 500 also did around 12%. The maximum drawdown here was only 29, whereas the S&P 500 was around 45. So we can see a little less performance in the last years here, but as you can see, it's working pretty consistently, and only have a couple of years that is 94 with a negative here. Then we have 2 years in a row here with negative. That was when the .com crash occurred here, and then it had a very good year when the market turned up again. So that is the overall performance of this. And if we are going back to our performance here, we can see that we are doing 12%, but in this time span, we are going from 2000 here up until 2023. In this time span, we had the .com crash here, we had the financial crisis, we had a downturn in 2018, we had the Corona crash, and we had the very tough market in 2022 with interest rates, inflation, war in Ukraine, and all that stuff. If we're looking at the annual returns, we can see here that the blue is the strategy The gray is the overall market, so we can see that a lot of years we are actually beating the market, but there are also years here in 2009, that's 2012 and so on, and there are a number of years, the recent years here, that have not been so favorable to trend following strategies. So this is not a strategy that beats the market every single year, but seen over a 23-year period, simply by picking stocks that are at the 52-week high, you will overall make more money if you are patient and you have time enough to stay in the market. Now, how do we find these stocks? Well, of course, you can go through the stocks one by one here in TradingView, but as you know, we are soon coming out with this My Stock Scanner. And in here we have a screener. There will be a lot more things to screen for in the future. But when we are looking at this, we can see this. And here we can just press this one close to, meaning that it is closing up against its 52 weeks high. And we can see when, for instance, it is at a 93, it is getting closer to its 52 weeks high. But if we're looking at, for instance, let's see, United States here, we can see that there are a number of stocks that are at 100%. When they are at 100%, it means they are at their 52 weeks high as of the close yesterday. Now, be aware that some of them have very low market cap, and that in our back test, we have only chosen stocks from the S&P 500. And of course, there's no survivorship bias errors in here, so we have only taken the constituents that have been in the S&P 500 the years where we looked at them. So many of these stocks are very small, and we do recommend that you move up. This is about a $10 billion market cap. You might even go up even further. You can choose more here, and soon we will have a market cap filter in here in the screen as well. And then you can say, I only want stocks that are above, for instance, 30 or $40 billion in market cap. That makes sure you're only getting the best one. You can experiment yourself with choosing stocks that are at a 52 weeks high, but are also at a very high stock rank here in our stock score, and you can choose all sorts of different trend parameters. But basically, this is it. Buy a stock at its 52 weeks high and hold it until it kicks through the ATR Stop Loss. That's it. And I should say that many of these stocks, I think it is actually in the document here somewhere, many of these stocks are being held 300 to 400 days. So actually many of these stocks are not really that active. You don't have to be a day trader or a swing trader to use this strategy. In our test, we have said that we want a maximum of 40 positions in the portfolio, and they are at 2.5% of the entire portfolio value each. But you could choose 20 positions or 10 positions. There is a general concept that the fewer stocks you have in a strategy like this, the higher your return will be, but the higher your volatility will be as well. So you will get more volatility and more drawdown if you choose only 10 or 15 stocks compared to 40. That's all. I hope you found this inspirational and educational. And as always, if you have questions, just write them below the video. I will leave a link both to the research here below the video, but also to a waiting list where you can put your email in, and we will notify you as soon as the stock scanner opens up to the public. That's all for now. Remember to hit the like and subscribe button, and take care of yourself and your money out there. I'll talk to you again shortly. Bye for now.